G'day there, Investorholics. Stick around today for another spotlight review on Australian ETFs. Today's the 14th of the 5th, and we're going to be looking at VAS, which is the Vanguard Australia Share Index ETF. Yeah, hang around. I think it'll be well worth your time. Well, hello there, Investorholics. This is Scott. KrackTheSky Value Investing will be giving you up-to-date investing news and content so you can navigate the markets wherever you are. My mission is to give you the knowledge and confidence to take control of your own personal finances, expand your investment horizons, and crack your financial sky. Okay, let's dive right in. So the investment objective here is the ETF seeks to track the return of the S&P ASX 300. So this is a bit different to the other large index trackers, which all track the ASX 200. So suitability, who might it be good for? Buy and hold type investors, so someone with a long-term investment horizon. It also is pretty tax effective if you're looking for income. And obviously, if you're investing in the stock market, you'll actually have a higher tolerance for volatility and risk. So that's always something to keep in mind when you're investing in the stock market. Long-term performance. Vanguard's investment approach provides investors with an efficient way to capture long-term market performance. Diversification, as we touched on before, you've got 300 stocks in this ETF. The fund invests in diversified portfolio of securities, which means the fund is less exposed to performance and fluctuations in individual securities. So the fund has low ongoing fees as well, and they're always looking to try to push those costs down. This VAS isn't actually one of the cheaper ones, but we'll have a look at that as we go over onto the next slide. So we had a net asset value of $67.66, trading just above that at the close yesterday at $67.74. Market cap's about $4.7 billion. Management fee is 0.1%. You get a distribution quarterly, so January, April, July, October, which is nice. Dividend yield is roughly 4.7%, but we may see that go down just depending on how all these companies have been impacted from COVID-19, but we'll keep an eye on that anyway. So VAS is ideal for long-term investors as it's proven to be a popular investment choice among Aussies, so it's one of the bigger ETF funds. This is perfectly obvious when I examine the year to date. So year to date we've seen just over $1 billion of inflows, and 12-month money flows we've seen 1.8 billion. So definitely this is a very strong ETF, and it's still very, very popular. So in the last 6 months the ETF has fallen 16.7%. We can all imagine why that has been. So anyway, from the late February highs anyway, so she's down a fair bit. The ETF provides a high level of exposure to all of the big blue chip companies listed on the ASX. VAS is a very good option to gain broad exposure to Australian equities from the shop that's specialised in passive investing. So pretty much these guys are really good at what they do. So I think one of the advantages of having invested in the ASX 300 as opposed to the ASX 200 ETFs or the index is you actually get the 100 smaller companies, and those smaller companies tend to grow a little bit faster than the bigger companies. So as alternatives to VAS, you can look at A200, STWIOZ. So competition is fierce amongst the ASX 200, 300 tracking ETFs with the big four players like Vanguard, which is this one, iShares, which is BlackRock, State Street, and also BetaShares. So pretty much fees for these big ETFs are pretty much going right down to sort of verging on zero almost with a couple of them. So they keep slashing the fees and trying to entice people to actually put money in their funds because the fees so low. So for instance, A200, which is the beta shares ETF, that has a management fee of 0.07%. State Street, which is STW, that has a management fee of 0.13%, and IOZ, which is the iShares BlackRock product, that has a management fee of 0.09%. So IOZ and A200 are definitely the lowest by a fair margin, but they're still, they're all kind of cannibalizing the same type of investor, I suppose. So struggling to get that money through. But overall, I think whichever one of these you choose, I think you're going to get a pretty good representation of the large companies in the ASX anyway. So let's take a quick look at what we get underneath the hood here. So you can see on the left hand side there, that's the top 15, and they make up a majority of the index anyway. So CSL, Commonwealth Bank, BHP, Westpac, ANZ, NAB, Woolworths, Wesfarmers, Telstra, Transurban, Rio, Macquarie, Goodman, Newcrest and Coles. So a lot of the very, very popular names, and also common names as well, I should say. So majority of people in Australia would know those names. So for long-term returns, can be boosted by assets, by buying assets at cheaper prices, like we're sort of seeing now. And looks like to me that the actual ETFs haven't rebounded as much as the actual individual stocks that make up these ETFs. So if you bought CSL, for instance, at the end of February this year, you probably, now you've almost made back up what the loss was at the low of the ETF, of the COVID-19 crisis fears type thing. Whereas I don't think the ETFs have actually come back as much. So I think the exchange traded funds like Vanguard, VAS are now much cheaper than they were a few months ago. So I just don't think that they've rebounded quite as much as the underlying stocks, and they're probably a better buy, in my opinion anyway, for whatever that's worth. Definitely, I think there's something to look at. And overall, since inception, you have a bit over 7.5%, which is not too bad. So definitely one of these ones to look at, sort of a slow burner. So we want to be building our wealth up slowly. So we're not really into the whole get rich quick shit. We're into the get rich smart type stuff. So steady as you go, and make sure we're learning along the way. So I think this one's definitely one to have a look at into the future. And like I say, it's actually got a pretty good rating there for Morningstar as well. So it's still rated bronze, and that's mainly because of the low fees. Are you interested in learning more about personal finance and investing in the markets? If you are, then smash the like here on the left hand side and caress the subscribe button on the right hand side. It's Crack the Sky Value Investing. We'll be giving you up-to-date investing news and content so you can navigate the markets wherever you are. Expand your investment horizon and crack your financial sky. Thanks guys. See you later.